Great. I think we have everybody here. Once again, hello everyone. My name is Davinder Valeri, and I'm the Executive Director of the Canadian chapter of the A4S CFO Leadership Network. I'm also the Director for Strategy, Risk, and Performance at CPA Canada. The impact of climate change and business valuations are inextricably linked, but quantifying the actual effects remains a challenge. Thank you for everyone for joining us today, and welcome again to the webinar on climate change and business valuations. This webinar will help you understand our first of a kind guidance, which is the A4S Essential Guide to Valuations and Climate Change that's been developed to help business valuators price climate change risks and opportunities. For the benefit of future viewers, we are recording this webinar and it will be available on our YouTube channel. Just a few ground rules as we kick off this virtual session. We have a lot to cover. We have an hour, so please keep your contributions relevant and help us stay on time. Please also stay engaged as much as possible. Please also note that participation, including responding to the polls, will be monitored throughout the webinar. James, if you want to share the slides, please. So on our agenda today, we have a few speakers from the project team. I will introduce them shortly. We're going to give you a few opening remarks, introduce you to the guide itself, and offer a deep dive into the Excel tool, and then we'll have time for Q&As. So for our learning objectives, after this webinar, you should be able to articulate the benefits of integrating climate risks and opportunities into business valuations. You should be able to understand the 5-step framework and become familiar with the Excel tool that accompanies the guide. We are using Zoom. Zoom has the Q&A function, and I encourage everybody to use the Q&A function and send in your questions. We will be asking questions once right after the introduction to the guide, and then again once the tool has been introduced. Polling, as I indicated, we will have a few polling questions throughout the session. Please utilize speedy answers if you can, and this will help us stay on track. And with that, maybe we'll test a quick polling question. Which department are you guys from? If you want to maybe answer to that. Okay. I think we'll move on to the actual polling question. James, are we good with that? So we're going to actually give you an actual polling question. How does your organization currently incorporate climate change risks and opportunities in valuation processes? Please tick all that apply. Okay, with that, I want to introduce you to David McGraw, the main reason why we developed this guide. David is the CFO of the Ontario Teachers Pension Plan, and David's going to give you a bit of an overview of the guide and explain to you why he led the development of this project. So David, welcome, and the floor is yours.
Well, thanks very much, Davinder, and welcome to the A4S webinar, everybody. So we're delighted to be joined by attendees from around the world. Let me first say good morning, good afternoon, and good evening, everybody. So first, we're going to give you a brief overview of the guide, and then we're going to take you through some helpful tools we developed to capture the impact of climate change on business valuations. But before I turn it over to my colleagues, Sandy, Tcfd, and Tobin, I'd first like to touch on why we decided to produce the guide and what was the motivation behind it, and what is the link between valuations and climate change. As climate change represents material risk to businesses and the economy, the impact of climate change is an increasingly important consideration when making investment decisions and determining the value of businesses. At the Ontario Teachers Pension Plan, a substantial portion of our investments are in private assets, including direct investments in private equity, infrastructure, natural resources, and real estate. So that's why business valuations for our private investments are very important to us, both from a financial reporting perspective, but also to inform our investment decisions. So when determining the value of a business, we've got to consider all the risks and opportunities of which climate change is one. So about a year or so ago, we started thinking more deeply about how to reflect the impact of growing climate change risks on our valuations And we did a scan of guidance available from valuation organizations around the globe, and surprisingly, found there is very little available. So this lack of guidance highlighted the need for a valuation framework to facilitate a consistent approach to factoring in climate change and valuation and investment analysis. This led me to approach A4S and CPA Canada with the idea of creating some guidance for investors, valuators, and other key stakeholders. So I was very pleased that both A4S and CPA Canada were enthusiastic. And it was on that basis that the Impact of Climate Change on Valuations Working Group was formed and the guide was developed. Now, we recognize that factoring climate change into valuations is in its infancy. But through this guide, we hope to inform the discussion among the valuation, accounting, and regulatory communities to encourage moving this topic forward into accepted practice. By doing so, we would expect a more robust disclosures in corporate reporting and a greater oversight by boards on this topic. So we hope that the guide will become widely referenced and used by valuators and investors in their valuations and in decision-making processes. With that, I'll pass it back to Davinder for the next segment of this webinar.
Thank you so much, David. With that, I'd like to introduce the different speakers that we have from the project team. So we've got here with us today, Sandra McEwen. She is actually the Managing Director of Valuations, Risk Analysis, and Model Validation at Ontario Teachers Pension Plan. Welcome, Sandra. We also have Tcfd Tran, Senior Director of Valuation, Caisse de dépôt et placement du Québec. And we also have Tobin, Senior Manager, Private Investment Valuations at Ontario Teachers Pension Plan. Again, welcome to all of them. And, you know, this is an opportunity for a bit of a conversation to talk about the guide itself. So let's get into that. I want to talk about the other members that were part of this project as well. So if we move to the next slide, James. You know, David talked about how the guide was germinated through a need that was addressed by Ontario Teachers Pension Plan. So Teachers was definitely a member of this project team, but we also had others from the Canadian network, such as OMERS and Brookfield. We also broadened our project team to include others from around the world as well. We had New Zealand Super Fund. They were a key contributor to this guide. We had the Canadian Business Valuators. We had the Financial Reporting and Auditing Standards from Canada. We had CPA Canada, obviously, and we had peer reviewers as well. The valuation community was actively engaged. We also talked to our counterparts in Europe and US from the A4S CFO Leadership Network, as well as the UN Coalition for Climate Resilient Investment. So the production of this guide involved a global engagement from around the world. And with that, I'm going to actually pass it back to Sandra and Tcfd to actually introduce the guide and talk to us about the framework. Sandra, Tcfd, welcome.
Great. Thank you, Davinder. So the guide introduces a practical framework for evaluators and investors to follow when integrating climate change risks and opportunities into their valuations. And we refer to this as the 5-step framework. And the framework outlines the following key steps. The first is to identify the company's key value drivers. The second is assess the source of climate change risks and opportunities. The third is filter the identified climate change risks and opportunities for those that are most significant and more likely to occur. The fourth is integrate the key risks and opportunities into the chosen valuation approach. And last, but certainly not least, is triangulate the identified risks and opportunities to market observations and iterate as required. The steps of the framework are not meant to be descriptive. Rather, they're intended to act as an aid in how to incorporate very real but often ignored climate change risks and factors into valuations. And it's important to remember that climate change is just one factor among many that need to be considered in valuations. But it's a relatively new area for consideration and an increasingly important one that can no longer be ignored or assumed away in valuations. So with the stage now set, I'd like to invite Tcfd to help me provide you with a bit more color and context on each of the 5 steps of the framework. So Tcfd, as I indicated, identifies the first step of the framework, and that consists of identifying the company's key value drivers. Now that sounds pretty basic, but interested to get your thoughts on the importance of this first step of the framework.
And the identify step of the framework may sound basic in its description, but getting this first step right is anything but simple. During the identify phase, we look at isolating the key variables and activities that drives the value within a business, and focusing on the wrong value driver or failing to identify the segment or market risk, climate, and other can be a fatal error. Valuators and investors should view this process as being fluid, which means that we need to constantly reassess and challenge those factors. And for example, the value proposition of the last decade may be different than the next one. Therefore, we need to reassess and challenge the risk and opportunity on a regular basis, I'd say at least once a year.
Thanks, Tobin. Great. Identifying the company's key value drivers is a fundamental step, and getting that first step right is anything but simple. Tobin, as you know, the second step of the framework is assess. So what's the key business drivers have been identified? An assessment of the potential climate change risks and opportunities most relevant to the company should be performed. So what are your thoughts on how users might assess and determine the key climate change risks and opportunities relevant to a particular investment?
Thanks, and this is a really important step of the framework, and start to home in on the exposure that the company and its key driver have to climate change. In addition to considering the specific actions and plans that the company has put in place, valuators and investors can look at various other sources of data to assess climate change factor beyond discussion with management, internal company data, including looking at the various sector-specific sustainability report, corporate disclosure across the industry, and other research from organizations such as that from the Tcfd, which is the Task Force on Climate-Related Financial Disclosure. And the Tcfd divides the climate-related risk into two major categories. The first one being the risk related to the transition to a lower carbon energy, for example, policy, legal, and technological risk. And the second basket is the risk related to the physical impact of climate change coming from, for example, extreme weather events or long-term shifts in climate patterns.
Thanks, Tobin. Agree. There's actually quite a few sources that can be looked to help identify climate change risks and opportunities that a subject entity might encounter. And the guide provides more details on these possible sources, as well as provides a list of several organizations and the types of information that can be derived from them. So after identifying the climate change risks and opportunities that a subject entity may encounter, those factors should be filtered. And filter is the third step of the framework. So based on consideration of the available information and professional judgment, we narrow down the climate change factors that should be evaluated more closely for incorporation into the valuation. Tobin, what are your thoughts on some of the challenges that you anticipate may be encountered in that filter step? And how do you think those challenges might be overcome?
Thanks, Sandy. A challenge that some may encounter is to assess the likelihood and impact, mostly in an uncertain environment, which has been further exacerbated by the current COVID crisis. I would say to help overcome this challenge, we must remain aware of recent market transactions and how the market participants view those climate change impact. And discussion with peers, forum, and panels can be good ways to stay informed on how the market view those climate change risk and opportunities. Scenario analysis can also be helpful to assess the materiality and from there decide whether we should integrate those risks and opportunities in the valuation model, which is the fourth step of the framework.
Thanks, Tobin. So that's a perfect segue into integrate. And in this step, the climate change risks and opportunities are incorporated into the actual valuation models, including discounted cash flows and market valuation approaches. Perhaps you can provide a bit more color as to how one might go about integrating these considerations into evaluation analysis.
Sure, Sandy. It should be mentioned that valuation is always performed from the point of view of the market participant. So we always need to consider whether a purchaser or potential investor would consider those climate risk and opportunities in their valuation. If they would, then the next step would see to determine how the cash flow profile and the terminal value could be affected, assuming we're using a DCF. And finally, we need to assess whether the expected return for this type of asset has evolved by through time. However, the risk and opportunities related to climate change are not considered in the valuation when the likelihood is of the probability of occurring is low, and there's too much uncertainty, or the market participant would not consider this factor in their evaluation.
Thanks for providing that additional context related to applying the integrate step of the framework, Tcfd. So let's move to the last, but certainly not least step of the framework, which is triangulate. So once the climate change risks and opportunities have been assessed, it's important to step back and consider or triangulate climate change risks and opportunities and the related impact on the subject entity versus its peers and other market considerations. So what are your thoughts on the importance of this final step of the framework, triangulate?
Thanks, Sandy. The first four step of the framework can be considered business specific or micro in nature. And in this last step, we want to ensure that when determining the fair value, we don't lose sight of how the broader market ascribe value to same or similar asset, or what you can call the macro aspect. We felt that it was critical in the framework to tie those two concepts together. And this could be viewed as the most valuable part of the framework to ensure that we arrive at what is considered fair value.
Thanks, Tcfd. Couldn't agree more. This last step of the framework, triangulate, is critical to ensuring we're not assessing fair value in isolation or in a bubble without taking into account the broader market considerations. So that now brings us to the end of this first segment. Davinder, I'll pass it over to you to conduct a second poll question and facilitate a short Q&A session.
Excellent. Thank you so much, Sandra and Tim. And I just want to make a note that, you have walked through the 5 steps rather eloquently. The guide definitely gives you much more detail as well. So, Sandra and Tim have given you something at a high level, but those that are seeking much more detail, please make sure to make reference to the guide and walk through those steps in much more detail. So with that, we'll start the polling question number 2. So what are the steps to integrating climate change impacts into business valuations? Again, please tick all that apply. As we're filling out the poll, I would also encourage folks, we're going to get into the Q&A session, to send in your questions utilizing the Q&A function in Zoom, if you haven't already done so. And I can start to at least scan through some of the questions. Great. So let's maybe have some questions. I know David's back. We've got the whole team here, all the speakers. So maybe we'll start with the first question. Incorporating climate change considerations into valuations sounds like a great idea in theory, but there's currently a lack of quantitative information available. How can users handle this? I'm not sure who wants to take this question, but anyone?
I can start us off, Davinder, if you'd like. So please. I think we acknowledge at present there's a lack of quantitative analysis around climate change in current business valuations, and that includes things like the lack of comparable information. So, comparisons between companies are often difficult or impossible because of limited disclosure requirements, the current limited disclosure requirements. However, that's improving with the rapid adoption of the Tcfd compliance reporting. And then the other thing that we do see is that, there's limited published scenarios. There's no suite of sort of generally accepted integrated assumptions that is consistently adopted by companies in their analysis. And as well as there's uncertainty. There's currently no agreement as to which projections around the impact of climate change on economies, industries, and the subject companies are most accurate at this point. And it's difficult to demonstrate the extent to which the markets are already pricing in some of these risks and opportunities associated with climate change. However, what I would say is that the guide does provide some really excellent case studies that were contributed by all the project participants, and those show real world applications of the framework to investment considerations despite the current shortcomings of the availability of information. And what I would say is that the names were changed of all those case studies, but those case studies actually all reflect real companies that we have respectively been involved in. I don't know if anybody else has anything else to add to that.
I think that's a great response. I think in addition to that, we do provide references to third-party organizations like SASB, where you can get some comparative information. But I think because valuation of climate change is in its infancy, there can be arbitrage here as well. So we do point that out in the guide that factoring climate change into valuation before anybody else has may be a competitive advantage. So this is why we think it's such an interesting field.
Yeah, and Sandy, thanks for bringing to light the fact that the case studies are actually great examples of how the guide can be utilized. And some of the names have been removed, you're right, but they actually are really relevant to this. Okay, so we've got some other questions here. Maybe I'll ask another one here. In what areas of company valuation models do you expect to see most impact of incorporating climate change risks? In the revenue line, business drivers part, in the OPEX or the CAPEX part, and why? I don't know if this comes from Simon Theos. He's asking this question. Anybody want to take it on?
I think it depends on the industry that you're in. Obviously, if you're in a highly capital-intensive industry and you're going to have to make changes to your business, then that's clear. If you're more in the services industry, obviously you're going to have to think about changes you might make to your supply chain. You've got to take into account any of the sort of policy or legal risks. But also, what we pointed out in the guide is that there's so many considerations that you've got to look at. And there's also a lot of opportunities, which I think is also important to point out. So it's by looking at the guide and looking at those criteria where we think this is what Tcfd mentioned, that the assessment is perhaps a key part of this, where you've got to think about what are the factors that you really have to take into account that are going to be material to your business, and then what's the likelihood of those things happening. So it's through that 5-step process where I think you will be able to get answers to your questions in terms of what should I really emphasize or not by methodically going through some of those key drivers.
Yeah, thank you, David. Here's a really interesting question. And what was the biggest revelation, I guess, during the development of the project?
Well, I think one of the biggest motivations was that, at Teachers anyway, we've been looking at ESG factors since 2007. And I think climate change considerations are accelerating, and even more during the pandemic. So it's always helpful to be at the front of issues rather than to be back of the issues. So I think the excitement that I had was to identify which organizations could really help us with this guide and put a great team together. And I think what we learned a lot from this, Sandy, I would think, and Tcfd and Tobin as well. As we put it through, when we first started, we said, gee, how are we going to get this thing going? What are the key considerations, and how are we going to get a framework going? So we started literally with a blank sheet of paper and then worked through it. And I think we've landed in a place where we're feeling comfortable, at the same time absolutely recognizing that it's still at the early stages, and that we hope that other stakeholders, including the people on this webinar, will help further the thinking.
And I think maybe to add to that, David, the fact that working together, right, putting together perhaps different methodologies that may have existed, but when everybody got together to come up with a common framework, that was probably the biggest revelation that, hey, we can actually work together to come up with something that works for everybody. Again, it's that opportunity for consistency and comparability across the board, right?
I agree.
Excellent. So did anybody else want to add to that, or?
One of the points that I would raise is, before going into this, I don't think it was apparent how different some of the forecasts were, meaning climate change, we all know it's real, but the impacts are so widespread and there's still so much uncertainty around it. And as we learn more about it, we started to learn how much we didn't know. So things like warming scenarios and forecasts, it can be anywhere from 1.5 degrees to 4 degrees in the next 30 years. And that's a very big difference. And then the associated impacts of that is still very unknown. And so that was one of the biggest revelations for us in terms of, there's still a lot of uncertainty out there. And we're sort of trying to identify those sources still. And also just the lack of consistency. Every organization and consultancy seems to have their own views on this and how to incorporate it and what the impacts will be. And so I think that was something that really was brought to light for me that going into this, I wasn't quite aware of.
Excellent.
Maybe just one other thing I just wanted to add, I think it was actually to the second question that was asked. One of the things I think that's important and that was the question as to where do you make the changes? I think the answer truly is it depends, right? Because each company has, to differing degrees, may have already considered some of this and have taken action to mitigate some of those risks. So, the adjustments or considerations or relative risk to a company that has already taken actions to mitigate some of those risks is different than the risks, that a company that has not done anything to mitigate those risks would have to be made.
Excellent. If nothing else, I'll move on to another question. Sounds good. How do you think, how would you think about changing your approach to assessing an appropriate discount rate, if at all, once cash flows have been adjusted for climate change risks?
I can take a first stab at that question, Davinder. I would say that if the cash flow profile has been affected, maybe the discount rate don't necessarily need to be adjusted. And another item would be to look at how market participants would view this. And an example where we start of industry where we start to have a lot of data is renewable energy. And if we look at analyst report of the WACC through time, we see that there's a certain shift, a certain decrease in the expected return that arise from the fact that there's a shift of a significant shift in capitals going towards renewable energy. I don't know if anyone has something to add.
I think another factor is where, you can't really quantify it in the cash flows, but that, a number of the risks have not been addressed and therefore the company has really not attended to this risk, then I think you would tend to look at the discount rate as well.
I think again, coming back to sort of that very last step of the framework, which is triangulate. Anytime you get, you can, company specific information where, whether there's been a sell down in the company or something, where you actually have evidence to simply mark the value against, that helps sort of, you figure out where, what is the true value, and then therefore what's falling out of the cash. If it's not getting captured in the cash flows, what then is getting relegated to essentially the discount rate.
Excellent. I have another question here, and this is actually kind of interesting. It's are the terms ESG and climate reporting used simultaneously in this framework? And I think that'd be a good one. I know definitions is always a challenge, right? Anybody want to take that on?
I can take a first stab at it, if you like. What I would say is that we focused on sort of the E of ESG as it pertains to this particular framework. So, you know, the climate change is directly related to the environmental piece of it, but certainly it's not to say that, you know, the S, which is social, is not extremely important, as well as the governance aspects.
So one of the transition risks we looked at and we list in the guide is market. And so that includes social factors, reputation, et cetera, et cetera. So, you know, obviously, if you aren't getting with program and other companies are, your company may be tainted by that and your brand may be impacted. So, you know, there's where the social comes into being in terms of you haven't really figured out what consumers are looking for when they're buying their product or services. So I think it's implicit in the guide, along with a number of other factors, but I think it's a great question.
Here's one about some examples. What are some examples of climate risks and valuation metrics that would apply to municipalities? Any thoughts on how we could extend it to municipalities?
Well, I think one of the things that first comes to mind is water.
Yeah.
Because as we know, you know, I've heard stats from some cities, they have 50% leakage. So, you know, that's a really big deal. And so those kind of factors where you're wasting energy, you're wasting resources, I think would be a pretty big deal.
Yeah.
You know, if we look at the whole topic of agriculture,
yep,
where, you know, some plants like almonds, you know, which we have some familiarity with teachers, you know, to grow almonds takes a lot of water. So from a climate change perspective, we've got to be really careful as investors that we're factoring climate change into that. So what we're doing is we are making sure we have drip process that you know, really allocate water very, very carefully as a scarce resource as we're looking at all these things. So there's a bit of an answer for you. That's the first thing that comes to mind, but obviously there's other things like power, you know, everything to do with the services that they supply to consumers. They'd like to figure out, are they doing it in the best way possible? Have they looked at their supply chains to make sure that the supply chains are addressing, you know, the most efficient and effective processes, et cetera, et cetera.
Yeah, and natural capital, I think maybe that's another angle as well, David. I think you mentioned agriculture, but natural capital could also work for the municipalities. Excellent. Okay, we'll do maybe one more from here, or maybe two more. While undergoing the valuation process, how do you filter greenwashing risks? A great question.
You know, I think the vendor, this is where disclosure comes into.
Yes.
We all know that the world needs much better disclosure. And we know that there's an alphabet soup of organizations that are out there with standards. But that's why I'm quite excited about the recent initiative by the A4S to look at a sustainability standards board to have, you know, one set of global standards. And I think, you know, if you get those standards and you get auditors opining on those standards, like they do for carbon footprints, and not just auditors, other organizations that are set up to review those standards, then you get reality in reporting. And I think that's really, really helpful because obviously consistent standards that are auditable are hard to argue with. So I think that will filter out quite a bit of greenwashing when we get that better disclosure.
So maybe David, you know, you in your opening, in your forward, you talked about informing the discussion amongst valuation, accounting, and regulatory communities to encourage moving this forward into accepted practice. You know, this might link into this part as well. So considering that, so what do you think are the next steps that we should consider in this?
Well, you know, I think the framework is a significant step towards sort of the systematic incorporation of climate change factors into valuation. And it could serve as a broader example of consideration of other ESG factors. But although it's a good start to the journey, I think it's important to keep developing and advancing this work. And I'm delighted that there are apparently 285 people on this webinar. So the extent that people can spread the word. And if you go on the A4S website, you'll see that the guide is right there along with the tool that Tobin will be taking us through. So I think advancing this work, making sure it's available to different stakeholders to utilize is really, really important. But as you can appreciate, with the involvement of multiple large pension plans and asset managers in the development of this framework, we would hope that we continue the momentum from it and influence other pension plans and large investors with regard to the topic of climate change evaluation. So, give you an example, Sandy, Tobin, and I have already started thinking about how to integrate the framework into teachers' standard practices. And we're going to be piloting this in our investments area this year. So we're really excited about that, and we're going to continue to monitor how it works and probably inform our decisions to do with valuations and the investment process as well. So
excellent. Thank you for that. Thank you for that. We had a whole bunch of other questions, and apologies that we didn't get to them. We do want to move on to the next part of the webinar, and if there's time left, perhaps we can come back to those questions. But with that, we would like to move on to the Excel tool itself, and this is where I'd like to introduce you to Tobin Shields, who's a Senior Manager of Private Investment Valuations at Ontario Teachers Pension Plan. So Tobin, the floor is yours.
Thanks, Davinder. Hello, everyone. This section of the webinar will focus on the Excel-based tool that accompanies the main guide. If anyone would like to follow along within the Excel tool themselves, please feel free to open it up now. And I would ask that A4S could share the PowerPoint again. Great, we can move to the first slide, please. So this slide discusses the purpose and use of the Excel tool. Our view is that valuators and investors can integrate this tool as part of their existing processes and should modify it or extract relevant sections of it to suit their needs. As we mentioned earlier, this tool is meant to be a framework for thought and is not meant to be entirely prescriptive. We noted that the availability and consistency of climate risk data is increasing over time, although it's not generally yet as robust compared to financial data. Valuators and investors will need to apply judgment when selecting and interpreting climate risk data, and therefore it's important for users of the guide and the tool to have a general background understanding of climate change data, and the related potential impacts. The Task Force for Climate-Related Financial Disclosures, or the Tcfd, framework for physical risks, transition risks, and opportunities has been referenced as a starting point within the guide, but users of this tool can adopt their own views or adjust according to their own needs. We note that this workbook has been protected to prevent any unintentional changes. Any blue text in the Excel tool can be edited freely, and drop-down menus have been added for ease of use in Schedules B and C. Certain schedules have also been interlinked for ease of use. Next slide, please. This slide discusses the guidance, overview, and Tcfd definitions. Climate risks and opportunities identified herein are based on guidance from the Tcfd. Please refer to the Tcfd document referenced in the footnote below for further detail. Physical risks are those resulting from climate change that can be either event-driven, such as acute events like an increased severity of extreme weather events, cyclones, droughts, floods, and fires. These can also relate to longer-term shifts, which are referred to as chronic. Things like changes in precipitation and temperature or increased variability in weather patterns, such as sea level rise. Transition risks refer to those climate risks that are associated with the transition to a lower carbon economy. The most common transition risks relate to things like policy and legal actions, technology changes, market responses, and reputational considerations. Opportunities. It's also important to consider opportunities and not only risks. Efforts to mitigate and adapt to climate change can produce opportunities for companies, such as through resource efficiency and cost savings, or the adoption and utilization of low-emission energy sources. In terms of the structure of this workbook, this tool includes the following schedules, which can be used to assist in identifying, documenting, and assessing climate change risks and opportunities. Schedule A, Risk and Opportunity Identification and Assessment. This schedule is an initial screen to assist in identifying sources of information of relevant climate risks and opportunities that could refer to the subject company, comparable companies, and the overall applicable industries or locations. Schedule B, Risk and Opportunity Scorecard. This schedule is meant to be a more detailed assessment that explains the risks and opportunities relevant to a subject company based on likelihood and impact, and includes a relative comparison to prior risk assessments to allow for the observation of any material changes. Schedule C, DCF Integration Framework. This schedule assists in integrating the identified risks and opportunities, which were previously identified in Schedule B, into a DCF analysis and considers the impacts to both cash flows and discount rates. And finally, Schedule D, Relative Valuation Framework. This schedule allows for comparison of the subject company's climate risks and opportunities to comparable companies for use in a relative valuation analysis, such as market multiples. Next slide, please. Schedule A, Risk and Opportunity Identification. As mentioned earlier, the following sources of information, among others, can assist in identifying the climate change risks and opportunities that the subject company is exposed to, which may be relevant to the valuation. We note that not all sources of information listed here may be currently available for some companies or sectors, but we hope that information will become more available in the future. Certain key sources of information include discussions with management. Because management is closest to the day-to-day operations of the company, they should have a deep understanding of the climate risks and opportunities faced by their company and the industry. Subject company and comparable company annual and sustainability reporting. Some companies are now beginning to disclose climate change data as part of their annual reporting, which can give an indication of climate risks and opportunities. External data providers. Various external parties are beginning to analyze, summarize, and disclose climate change risk and opportunity data regarding both physical and transition risks, primarily for public companies and the industries most impacted by climate change. Certain other sources of information can include the SASB materiality map and equity analyst reports. We note that the quality of information and availability of disclosures differs across companies and across sectors. Sources of information are evolving over time and are expected to become more robust and more consistent in the future. Please refer to page 23 of the guide for further detail. Next slide, please. Here is an example from one of the cases identified within the guide, wastewater management. This shows that based on information available from 4 various sources of information, management, comparable companies, equity analyst reports, and external data providers, we were able to identify certain main risks. The key risks identified through these various sources included things like rising sea levels, water supply regulations, and long-term energy contracts. An opportunity regarding rising dam levels was also identified. You can refer to the guide for further examples of the detailed case studies. Next slide, please. Schedule B, Risk and Opportunity Scorecard. In the top section, you'll notice we have the warming scenario assumption. A key assumption for the analysis is the forecasted warming scenario. For example, +2 degrees Celsius by 2050, and the resulting implication on the physical and transition risks and opportunities. This assumption appears at the top of the schedule because it is a key driver. It's also important to consider whether the warming scenario assumption has changed over time, or if the implications of the current warming scenario have changed. As there's currently no unanimously accepted warming assumption, for example, some climate science data forecast temperature rises anywhere from 1.5 degrees to 4 degrees or more. So each organization may have their own views on the warming scenario and the related implications, leading to a lack of consistency. Risk and opportunity documentation. It's important to document each key physical and transition risk and opportunity as identified from Schedule A. For each risk and opportunity, assess the likelihood and the impact. Then assign an overall rating to each risk and opportunity and compare that to any prior assessment completed, for example, last quarter or last year, to assess if the overall rating has changed materially. The tool includes drop-down menus added for ease of use. Here they range from low to very high. We also note that the overall rating on the far right side is not mechanically derived from the likelihood/impact, and therefore is judgmental. There is also space for written documentation of the rationale and conclusions. In the case of wastewater management, this slide shows one example, the assessment of the risk of rising sea levels, which was assessed as moderate, and the related impact, which was assessed as high, with an overall risk assessment of moderate, which was unchanged from the previous assessment. This also includes documentation around the rationale for that conclusion. Next slide, please. Schedule C, DCF integration framework. For each risk and opportunity identified on the scorecard from Schedule B, use Schedule C to consider how to include these within a DCF analysis. This table shows the thought process behind whether the risk or opportunity should be included in the discount rate, in the cash flows, or both. Generally, as quantifiability, reliability, and the certainty of risks and opportunities increases, it's preferable to include these in the cash flows rather than the discount rate, although this is at the discretion of the valuator. For example, a highly uncertain cash flow impact that is challenging to quantify with a low reliability of cash flow impacts, such as potential regulation which has been proposed but not yet passed in law and with uncertain timing, could be considered in the discount rate. Whereas if this regulation were enacted in law and the cash flow impacts were known and highly quantifiable, these could be considered in the cash flows instead. Users should consider how this thought process integrates with their overall valuation process and procedures, and they could take a different approach. Next slide, please. Cash flow and discount rate impacts. Consider whether the identified risks and opportunities should be reflected in the cash flow forecasts or discount rates or a combination of both. It's important to document the rationale and conclusion here as well. We note that this schedule, Schedule C, auto-populates from Schedule B for ease of use. A drop-down menu is included in the quantification conclusion on the far right section for ease of use to track how risks and opportunities have been reflected within the DCF. In the case of wastewater management, one of the key risks, sea level rise, was considered in the discount rate, given the challenge of quantification within the cash flows, while the opportunity of dam levels rising was included in cash flows given a greater ability to quantify this. You'll see that the rationales here are also documented. Next slide, please. It's important to consider any premium or discount within the discount rate related specifically to climate change and how this may have changed from any prior assessment. For example, the underwriting or acquisition case or any other reference transactions could be used to calibrate a climate change premium or discount to be included in the IRR or discount rate upon acquisition, which can then be tracked over time, similar to a company-specific risk premium or an alpha. In the case of wastewater management, a 50 basis points premium was included in the acquisition discount rate, which has now been increased by 25 basis points in the current valuation due to changing assessments of extreme weather and water supply regulations, accounting for incremental risk that has not already been reflected through the cash flows. The quantum of the premium or discount is judgmental, similar to alpha. And it's our hope that additional guidance may arise in the future once more empirical data becomes available. Next slide, please. Schedule D, Market Valuation Framework. This schedule is designed to compare the subject company to a set of its peers using a combination of the Tcfd framework and other industry-specific climate change metrics, subject to the judgment of the valuator. This can be thought of as being very similar to a comparable company analysis that would be performed by considering key financial metrics, such as size, growth, and profitability. The subject company and any of its peers can be compared using overall climate risk ratings, geography, and other industry-specific metrics. It's also important to consider material changes in these risks over time. The schedule should draw on the same sources of data that were identified in Schedule A. The evaluator should then consider any adjustments applied to the peer company valuation multiples, such as EV, EBITDA, EV revenue, price earnings, etc., based on the climate risk analysis. Next slide, please. In the case of wastewater management, its overall climate risks were considered comparable to its two core peers, and therefore no premiums or discounts to the multiple for climate change risks were applied. The schedule shows the assessment of the sector, water utilities, the local state geographies, as well as scope 1 and 2 CO2 emissions, and the overall assessment of physical and transition risks. The overall assessment rationale has also been documented. The last section at the bottom of this schedule shows the calculation of the relative valuation multiple, allowing for adjustments for industry-specific metrics and exposure to physical or transition risks, as well as comments and rationale, if applicable, and the overall impact to the valuation multiple. Next slide, please. Hopefully that was a helpful walkthrough of the Excel tool, and we'll pass it off to Davinder for any Q&A with the audience. Thank you.
Thank you very much, Tobin. That was well done. I think before we open up the Q&A, I'd like to put a polling question in. What actions will you take away from this webinar? Please tick all that apply. Okay, Tobin, I mean, as we're answering the polling question, I'm going to ask you a question as well. I guess, what will be some challenges in practically adopting the tool into the existing valuation processes, procedures? Any thoughts around that?
Yeah, good question. I think, well, the spirit of valuation work across companies is similar. The actual processes and procedures in place can differ greatly from firm to firm. And this is why we suggest using the Excel tool first and foremost as a framework for thought to ensure that evaluators are asking themselves key questions and keeping track of major risks. For example, when developing the assumption around the future warming forecasts, it's important that these are kept internally consistent across assets. Therefore, having the warming scenario assumption explicitly stated will help keep that subject top of mind for the analysis, even if it takes a different form than that presented within the tool. We're also encouraging users to adopt what they find most useful and meaningful from the guide and the Excel tool, and encourage them to integrate it into their existing processes to ensure that the analysis is as efficient as possible, while still capturing the spirit of the guide and the Excel tool, without having to completely redesign any existing processes to force the inclusion of the tool in its current form. We realize that it's unlikely that the tool in its current form would fit perfectly into a firm's existing processes or procedures. I think the initial adoption of a climate change analysis in valuation will likely be challenging, as is any first time analysis. Similar to the challenges that many organizations faced integrating COVID-19 into their valuations last year, as this introduces new uncertainties and additional workload required above and beyond the typical valuation analysis.
Excellent.
To begin with, it may help to initially select a smaller group of companies that are more exposed to climate change risks in various asset classes. For example, within infrastructure, real estate, private equity, based on industries or their locations, to be used as pilot projects before expanding the analysis into the full private portfolio, which could be rolled out over time.
Excellent. And I think I'm just going through a few questions that we're receiving as well. I have one here. Given the rate of disagreement between different providers of climate scenarios, would you recommend using a range of scenarios and getting consensus estimates? Any thoughts around that?
That's a great question. And I think it goes back to the point that there is a range and there's a lot of uncertainty. And we just don't know what the next 30 years will hold. So I think that's why it's important for users of the guide and evaluators to be up to date on climate change data and to use their judgment in deciding where they think they should land within that range. Perhaps consensus estimates is the best way to go, and also being consistent within their own organizations to ensure that you're using that consistent warming assumption or the impacts.
Excellent. I mean, there's another question here. For the risk matrix, Tcfd also recommends using vulnerability and speed of onset. Would that change the computed output of the model?
So in terms of computed output of the model, again, we've left it non-mechanical so that the evaluator can exercise their judgment in deciding what the impact is. I think that the TCFD framework, which goes into more detail, should factor into that decision. And that could probably be categorized under likelihood or impact. I think a lot of it is up to the evaluator and their judgment. And that's why the model is not meant to be prescriptive. It's meant to be more of a framework for thought.
Excellent. I want to invite the other panelists on these questions as well. There's one here. It says, this is a great project and well done for taking the lead. As a valuer of infra businesses, the piece I struggle with is benchmarking. And the best place to observe this is in the public markets. Unfortunately, with a lot of infra businesses being taken private, the data points are shrinking. In quantifying premiums, how would you go about establishing the good, okay, and bad based on reference to the public market data? Anybody want to take that on? Good question.
So I'll take an initial stab at it and agree. Unfortunately, yes, some of the public information is becoming sort of less. But I think not only looking at sort of just the publicly listed companies that might be in the infra space, but also looking at the transactions that will also help provide or inform your analysis. And a lot of that, often these might be private transactions or private transactions, but a lot of times, if you are playing in that market, you actually do have access to that some of that information.
Excellent. There's a quick question here on Scope 3 emissions. Have we factoring those in? Are we going to? Just any thoughts on that?
I think Scope 3 emissions should be considered, but at this point, I understand they're very challenging to determine. They're sort of the most uncertain and the hardest to quantify. And I guess it depends on disclosure and reliability. So if there are reliable Scope 3 CO2 emissions for the company and for peers, great. But I think Scope 1 and 2 are more readily available and are more reliable today, but hopefully that changes in the future.
Exactly.
I agree with Tobin. I think the fact that value chain is now under the spotlight with the impact of COVID, you're going to be seeing a lot more people look at it and make that determination.
Exactly. There's a comment here. Is there a plan to invite and include other major stakeholders, such as real estate appraisers in our project, so that we can improve the comprehensiveness of the guidelines and the frameworks? And I think David mentioned this, that this is just version 1.0. I mean, this is something that we would like to repeat again next year, updated. But if there's others that are definitely interested and feel they should be part of this project, please reach out to A4S and go on our website. With that, maybe I'll thank the speakers. Thank you, Sandra. Thank you, David. Thank you, Tiemann. Thank you, Tobin, for your time. I also want to thank the listeners. This was definitely a valued webinar. I also want to maybe just highlight that those that are in the accounting or the finance professions, the A4S is holding our academy. Our cohort is starting. If you are interested in participating, please register. Go on the A4S website and put your request in for registration. I'll also put a plug again for the guide itself. If you haven't downloaded it, please go to the CPA Canada website or the A4S website, take a look at the guide, download the tool, play around with it. We welcome any thoughts and feedback on this guide as well. We would like to revisit it again next year, but again, I want to thank everybody for participating in this webinar. And with that, I'll sign off.